So what is the ICT Unicorn strategy? The ICT Unicorn is a trade entry strategy from ICT that focuses on high-quality setups formed by the overlap of a breaker block and an unmitigated fair value gap. This overlap marks areas where market structure fails and institutional imbalance creates strong price reactions. The concept is straightforward. A failed order block turns into a breaker block while a fair value gap forms in the same zone. When these align, they create a high confluence area where price often retraces before continuing or reversing with precision. The strategy is based on three core elements: market structure, breaker blocks, and fair value gaps. Together, they explain how liquidity events and failed overflow lead to repeatable high-probability trade entries. Let us start with the breaker block. A breaker block forms when a valid order block fails and flips into a new supply or demand zone on the chart. In basic price action, we already know this behavior well. When price breaks through support, that same level often acts as resistance later, simply because of how traders react to it. The same principle applies to order blocks. An order block can fail due to a shift in market structure and overextended price, or price tapping into an important higher time frame level. When a demand order block fails to hold and price breaks through it, that area flips into supply. This flipped zone is what we call a breaker block, and it becomes an area where we expect price to react and reject. Now let us talk about fair value gaps. Fair value gaps are also treated as supply or demand zones because they represent imbalance in the market. When a bearish fair value gap appears, it shows that selling pressure has clearly outweighed buying pressure, often driven by institutional activity. This creates market inefficiency, and price usually returns to that area to rebalance. When price revisits the fair value gap and there are still unfilled orders inside the zone, it creates an opportunity to trade in the direction of the existing momentum. That is when we often see price reject from the fair value gap and continue moving with strength in the same direction. It is important to keep one thing in mind. Fair value gaps must be unmitigated to remain valid. When a breaker block overlaps with an unmitigated fair value gap, this alignment creates a high-quality trading zone. When price returns to this area, the probability increases that it will behave as a strong supply zone and push price lower. In this situation, the entry is taken at the start of the zone. The stop loss is placed above it, and targets are set at the next key area ahead of price. The same logic applies in bullish scenarios, just in the opposite direction. Now let us look at a practical example using the euro-dollar on the 5-minute chart. We focus on the top of a recent impulsive move where a fair value gap has formed. The candle that created this gap can also be seen as an order block, marking a demand zone that would normally support price and push it higher. If price retraces into this zone, the expectation is usually a bullish rejection and continuation. But when price returns and breaks through the zone without holding, that demand area fails and flips its role. At that point, it becomes a breaker block. The bearish move that breaks below this former demand zone also creates a bearish fair value gap, signaling strong downside momentum. On their own, both the breaker block and the bearish fair value gap are meaningful areas. But when these two zones overlap, they create a high confluence trading zone. This overlap significantly increases the importance of the level and makes it a key area to watch for a strong market reaction. High confluence areas are zones where multiple price action signals come together, which naturally makes them more reliable. When different concepts align in the same area, more traders pay attention to that level. Because of this shared focus, these zones often trigger stronger and cleaner market reactions. That is why they become key areas where traders prepare, anticipate, and execute their trades. For the entry, The approach is straightforward. Place your sell limit order at the beginning of the high confluence zone and position your stop loss above the zone to protect against unexpected moves. When defining targets, aim for a healthy risk-to-reward ratio, such as 1:2 or 1:3, always based on the next important market structure levels ahead of price. To manage the trade more efficiently, one simple technique is to reduce risk once price reaches a 1-to-1 target. At that point, you can close half of the position and move the stop loss to break even. This way, even if price reverses and hits your stop, the trade does not result in a loss. At the same time, the remaining position is free to run in profit, allowing you to stay calm and focused while the market does the work. Another way to approach the entry is by waiting for price to return to the trading zone and then watching how it reacts. Instead of placing a limit order, you wait for a clear candlestick rejection, such as a long wick showing strong rejection from the zone. This method is especially useful when the trading area is wide, as it allows you to refine the entry and achieve a better price. In this case, the stop loss is placed beyond the trading zone, and the same exit rules apply. By using both approaches, you create a balance between confirmation and reward, which helps you trade with more confidence. Now let us shift to a gold example on the 15-minute chart. The market is in a clear downtrend, and the most recent impulsive move has produced a well-defined fair value gap, signaling strong bearish momentum. Inside this retracement area, we can identify an order block that offers a potential entry zone for sellers. If price holds below this area, the bearish bias remains intact. However, if price breaks above it, that behavior can signal a shift in direction and the possibility of a reversal. Pay close attention to how price forms an overlapping fair value gap and breaker block in this area. This overlap creates a high confluence zone, which is exactly where we look for high probability reversal trades. The plan is simple. Enter at the start of the confluence zone. Place the stop loss just beyond it to protect against unexpected moves and target the next key market structure levels ahead of price, always aiming for a favorable risk-to-reward ratio. This setup allows us to trade with more confidence because it is based on alignment, not guesswork. When multiple price action signals point to the same area, accuracy naturally improves. By following this structure, we increase the probability of catching quality reversal trades while keeping risk clearly defined and controlled. Since this entry can be part of a reversal strategy, it is important to highlight the role of multiple time frame analysis. Better results come from combining lower time frame entries with higher time frame context. This includes top-down analysis, understanding the broader market trend, and marking key supply and demand zones on higher time frames before looking for entries. For example, in the gold scenario, imagine price has reached a higher time frame demand zone. If the unicorn model forms inside this area, it creates strong confirmation. The higher time frame context supports the trade, while the lower time frame provides precision for execution. Even if the lower time frame shows short-term bearish momentum, the higher time frame structure may still be bullish. In that case, a long entry aligns with the dominant trend, which greatly increases the probability of reaching the intended targets. So trader, please remember that the Lucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.